inventory, I'd like to talk about how inventory and variable costing, absorption costing affect profits in accounting sense, but in terms of real profits, why a periodicity of reporting really alters how profits may look like. Okay, so we're going to see a difference between absorption costing and variable costing, and how an entity which is essentially doing the same thing may look different under the both costing terms, and how it would affect if we were given a choice of variable absorption and absorption costing when we are doing accounting as per the accounting standards. But first we'll go through the costing part, then we'll talk about the accounting part. Okay, so the question here is, if I have a normal production capacity of 10,000 and I'm producing at the normal production capacity, which is ideal equals to actual, so my true profits would be same. All right, it seems fine. Our sales are 10,000 in the first year, 5,000 in the second year, and 15,000 in the third year. Okay. Selling price is constant, assuming inflation is zero, which is a superficial one, but to make things easier, we are going to assume that. The variable cost is again same as forever, 6. So we don't find ourselves in a difficulty with inflation. We are assuming inflation is zero, which is superficial, I know, but to make things easier, we'll use this assumption. Our fixed cost again same, 40,000 per period, because in the previous one we had 1,000 units of capacity. I've increased it to 10,000, so simultaneously it becomes 40,000. Okay, and it is constant again, assuming no inflation. I know it's superficial, but of course bear with me. So in absorption costing, what we would need is fixed overhead absorption rate, that is FOAR, and we would need the closing inventory, the opening inventory in units, and inventory valuation. So don't worry, I have got that calculated over here. I'll just expand this. Why is it not expanding? Okay. So the fixed overhead absorption rate based on the accounting terms. We are talking about accounting here as per accounting standard 2, Indian accounting standard 2, and your international accounting standard 2. The inventory as per paragraph 13, we are doing the same thing. We'll use the minimum of whichever is the minimum, in case the normal capacity or the production capacity, whichever is minimum, we'll use the absorption rate as 4. Okay, so in this case, because everything is constant, we don't care about it. Okay, so it will come to 4,000 in all of these circumstances, that is production units are equal to the normal capacity, therefore 4 is the absorption rate constant. Inventory valuation, fixed cost plus variable cost per unit would come to the inventory cost, that is 10. So closing inventory, we can calculate it straight away, that is in the first year we have produced everything, we sold everything, so we get 0. In the second year we produced 10,000, we sold 5,000, we have 5,000 closing inventory. And in the third year we had opening 5,000, we produced 10,000, we sold 15,000, so the closing is 0. That's fairly evident. So under absorption costing, what we would see is the following. That is, the sales would come to 10,000 times 12. The second year it would be 5,000 times 12. And in the third year it would be 15,000 times 12. All right. I would just zoom it out so it becomes more easier to see. Okay. The fixed variable cost would remain the same because we are producing the same number of units. All right. We would have the fixed overhead cost, that is same every year because we are producing the same number of units. There is no overhead over absorption or under absorption because the production is equal to its normal capacity. And we have opening inventory cost added, and we decrease the closing inventory cost, or decrease, not decrease, but we deduct the closing inventory cost to arrive at gross profit. So the gross profit is 20,000, 10,000, and 30,000 in an absorption costing. That is the accounting sense really as per AS-2. All right, AS-2 or the International Accounting Standard 2 or the Indian Accounting Standard 2. All right, this would be your gross profits. There would be nothing beyond that. So bear with me and let's try to solve it for variable costing. What would be the sales? It would be same. All right, it would be same. We would have the same sales. Why? Because selling price is same, sale units are same, so we would have the same. Variable cost, it would be again same. Okay, because we have produced the same thing, we have sold the same thing, everything would be same. Opening inventory, as you see, there is only closing and opening inventory over in the second year, so I'll just For the sake of time, I'll use zeros, or rather would say, since we are in a variable costing, so we would have the variable cost, and this is opening inventory, I guess. And to make things easier, I would just add a 5 the dollar. So opening inventory cost is this, and closing inventory cost again we would do this times 6, that is this, that is $8. I would have to add it, and we'll have our closing inventory cost. So the gross profit would come to this minus this minus this plus this. Okay, so this is our gross profit, and we have our fixed cost, that is 40,000. So we'll have 40,000 of fixed cost, and we will be making this much operating profits, right? You see how it is different in variable costing and absorption costing, that is the AS-2 or the Indian Accounting Standard 2 or the International Accounting Standard 2, and our variable costing methods. So in variable costing, you would see in the last period where we sold all of our opening inventory, we made huge profits, because that's where we realize our profits. We are not carry forwarding our fixed costs. So I would like to think inventory as a method to defer your cost. So in case you are doing absorption costing, what you are essentially doing is deferring your fixed cost incurred. Whereas in terms of variable costing, you will not be deferring your fixed cost, you'll just be deferring your variable cost. So I think variable costing really gives you the true picture of how you have performed in a year. So in the second year, while you produced 10,000 units, you incurred the cost of 10,000. You did not sell the 5,000 units which were remaining in the closing inventory. So you made an operating loss of 10,000. I think this is close to your cash flows. So now the analysis is the same. What you would be doing is just adding everything up here. You would be adding everything up here, and what you would see is in the 3 years, we have essentially performed in the same manner. We have incurred the same fixed cost. Okay, we've incurred the same fixed cost. We have made the same type of revenue. We have made the same type of variable cost. What we were essentially doing is altering our closing inventory valuations, but we still made the 60,000. So in this manner, what the entities can really do as a financial shenanigan is boost profits accordingly, using the variable costing sometimes, using the absorption costing sometimes, whatever may suit their profit and loss statement. But you have to see the profit and loss in a long-term manner as an average. It's a long-term average. Profits are usually averaging out, because life cycle of a corporate, life cycle of a company, life cycle of a manufacturing unit does not necessarily have a cutoff of 1 year, 2 year, 3 year. So you understand that we have created superficial periodicity in accounting for reporting purposes. That is, the 31st March is our reporting purpose, but the changes in your profitability may happen anytime between. So understand the life cycle of a corporate, and understand that the profits are usually averaging out, no matter what accounting shenanigan you may use, unless it is beyond your accounting standards. Okay, so the accounting standards usually deal with all the financial shenanigans relating to inventory. However, I think they do not emphasize much on valuation part of the inventory. And I guess that is all for this video. I hope you found this useful.